The Nasdaq hadn't even opened when copper futures plunged 7%. Bond yield spiked. The Swiss franc tumbled to a 6-week low. And America's closest allies awoke to a tariff map that looked less like policy and more like economic warfare. At 6:42 a.m., President Trump signed an executive order, sweeping tariffs of 10% to 50% on 69 countries, effective August 7th. These weren't warnings or negotiating tactics. They were signed, sealed, and imminent. The global trade order had just been reshaped overnight. Canada, despite its USMCA membership, now faces a 35% tariff on all non-USMCA goods. Switzerland is hit with 39%, Taiwan 20%, Cambodia 19%, Syria 41%. But unlike earlier rounds, these tariffs weren't targeted. They were systemic. In Geneva, Swiss agricultural executives were still attending a national holiday event when the news broke. 50% of Switzerland's exports to the U.S. are pharmaceuticals. Their entire pricing model just collapsed. Ottawa called the move a direct betrayal. Canadian central banker Mark Carney had met with Trump just 2 weeks prior to stabilize trade talks. Canada wasn't just an ally, it was buying more U.S. debt than China. And now it was being punished more harshly than Beijing. That's not an oversight. It's a strategy. China, which has faced years of U.S. accusations, currency manipulation, dumping, systemic IP theft, was hit with just 30%. Despite a $295 billion trade surplus with the U.S. last year, China faces fewer penalties than Switzerland, Canada, or Brazil. And that's the first contradiction. America is taxing the very allies who have helped finance its deficits harder than its primary strategic rival. Markets were shaken, not because tariffs were unexpected. They'd been floated for months, but because the logic behind them had evaporated. Brazil, with a modest surplus, got a 50% tariff. India, with a larger surplus, only 25%. No one could decipher the formula. Tech stocks fell 2%. Copper, steel, and aluminum sank. Boeing and ExxonMobil rose. Wall Street understood the executive order for what it was: weaponized purchasing. The fine print revealed that countries agreeing to buy U.S. LNG, aircraft, or debt could renegotiate their tariff rates. This wasn't trade policy. It was a ransom menu. That's not spin. That's a direct quote from Trump's trade representative, James Greer, who said, "Some of these deals are fixed. Others depend on what countries offer." But the most immediate damage was in Asia or Europe. It was in North America. Canada sends 78% of its exports to the U.S., over $560 billion annually, roughly a quarter of its GDP. You can't reroute that kind of trade overnight. You can't find new buyers in a year. Yet tariffs of up to 35% now hit critical Canadian sectors: autos, aluminum, car parts, raw timber, and steel. Even if Canada retaliates, the U.S. market is irreplaceable, and that's exactly why it was targeted. But here's the deeper contradiction. While Canada faces harsh trade penalties, it remains one of the largest net buyers of U.S. treasuries. It is subsidizing the American deficit, while being punished for the very imbalance it helps finance. As the U.S. penalizes its allies, it expects them to absorb the global shock. Germany, France, Japan, and the U.K. all increased their U.S. bond holdings this year. All are now facing tariffs of 15% or more. The U.S. built a global deficit machine and has now turned on suppliers that keep it running. It's taxing them for the imbalance it created. Let's pause here, because, frankly, this isn't strategy. It's inversion. The foundational logic of trade, as collaboration, has collapsed. What we're witnessing is protectionism disguised as debt extraction. Trump's calculus is clear. Run the economy hot, inflate exports, shrink imports by force, plug the deficit with tariffs, and fund the fiscal gap with foreign-held debt. Then dare everyone to walk away. But one player isn't playing the game: China. Unlike the G7, China has not retaliated. It hasn't even issued a formal statement. While U.S. officials scrambled to initiate damage control, China's delegation, led by Vice Premier Julie Fan, has remained silent. And they don't need to act, because these tariffs don't just hit China. They hit China's competitors too. Taiwanese semiconductors now face a 20% tariff. Singapore and South Korea are hit with 19% and 22%, respectively. China can afford to wait. Its rivals are being softened for it. Publicly, the U.S. China trade deal is being framed as productive. But even Greer's comments suggest otherwise. We pushed hard. We made our positions known. I believe we have the makings of a deal. But the numbers tell a different story. The The trade deficit with China stood at $295 billion last year. The new deal will reduce it by just $5 billion, a 1.7% improvement, barely above the average quarterly fluctuation in agricultural commodities. Statistically, it's noise, and that $5 billion drop doesn't come from the U.S. exporting more. It comes from importing less. That's not rebalancing. That's bilateral shrinkage. And as U.S. imports fall, consumers pick up the tab. In June, the Consumer Price Index showed medicine prices had jumped 8.7%. Swiss generics account for over $10 billion in annual U.S. imports, now facing a 39% tariff. That means either prices rise or supply drops. In both cases, American consumers bear the cost. And here's where it gets even more tangled. The U.S. now applies a 40% penalty on all goods transshipped through third countries. That means if China sends goods to Malaysia or Vietnam and they're rerouted to the U.S., the penalty still applies. Even when the importing country is technically an ally, the new tariffs have effectively paralyzed regional supply chains. U.S. importers are freezing orders, not out of protest, but because they genuinely can't predict which shipments will be retroactively taxed. Goods already en route are now facing unexpected penalties upon arrival. The Commerce Department claims the rules of origin are under review. That's not policy. That's entropy. And in the background, BRICS is moving. At the Rio summit, the expanded BRICS bloc, which now includes Iran, Egypt, Nigeria, and UAE, signed 4 separate currency swap agreements. Russia and India agreed to settle 40% of bilateral trade in rupees. Brazil and China signed a deal to conduct 70% of soy and machinery transactions in yuan. It's not full de-dollarization yet, but it's unmistakable drift, and it's accelerating. In 2000, BRICS accounted for just 10% of global exports. By 2023, that share rose to 23%. The G7, meanwhile, fell from 45% to 29%. And by 2026, BRICS is projected to overtake the G7 in total merchandise exports, a shift originally expected to take a decade. Trump's tariffs may compress it into 3 years. As G7 members scramble to pay new duties or negotiate exemptions, BRICS countries aren't reacting to changing rules. They're writing their own. And as the U.S. pushes for reshoring, it's inadvertently pushing Europe and Asia to restructure their trade maps. Germany's BASF just signed a 10-year deal to open a rare earth processing plant in India. Japan is expanding uranium supply chains with Kazakhstan. The EU is negotiating a semiconductor framework with South Korea and a raw materials alliance with Mongolia. This isn't decoupling. It's redirection. And yet, Trump isn't backing off. He's doubling down. A new executive order signed on July 30th, 2025, and effective August 29th, removes a de minimis exemption for imports under $800, meaning even small consumer items will now face full tariffs. Walmart, Target, and Best Buy have already issued warnings about holiday season pricing spikes. U.S. consumers are about to feel the pressure, just in time for Q4. Inflation could tick up again, and the Fed, already under political fire, may be forced to pause or hike interest rates. Meanwhile, Trump continues to post defiantly. On Truth Social, he wrote, "The August 1st deadline stands. No extensions. A big day for America." It was a big day, just not in the way he thinks. What began as a campaign to punish China has metastasized into a global reordering. A $25 billion Treasury bond auction failed days after the tariffs were announced. Foreign indirect bids dropped to 58.9%, a 6-year low. That's not a dip. That's rejection. And here lies the final irony. The U.S. is punishing countries for running surpluses against it, while depending on those same countries to buy the debt that sustains its economy. It's built a system that no longer feeds itself, and is now taxing the feeders. Trump thinks he's cornering China. In reality, he's cornering America, and the only way out may be to dismantle the very architecture the U.S. spent 70 years building, just to claim a victory in a war it's already losing. Because the G7 didn't collapse. It got outmaneuvered. As the G7 recalibrates, BRICS isn't waiting. It's building an entirely new framework. China's Ministry of Commerce reported a 12% surge in UAE-based trade settlements in Q2 alone. Indonesia and Egypt now conduct more than half their bilateral trade in local currencies. India bypassed SWIFT to ink its first long-term rupee oil deal with Iran. The dollar isn't collapsing, but its indispensability is. As tariffs fracture long-established supply chains, companies aren't waiting for governments to sign new agreements. They're already migrating. BASF froze its $4 billion expansion in Texas and doubled R&D spending in Gujarat. Siemens shifted its data infrastructure from Virginia to Singapore. Samsung rerouted final assembly from Ohio to Jakarta. This isn't diplomacy. It's self-preservation. And the White House's response? More tariffs. This time on digital services, financial licenses, cross-border data. A new war on intangibles. But the contradiction remains. The harder America squeezes, the faster its leverage bleeds out. Not with a bang, but with quiet exits. Because this is no longer about punishing rivals or rewarding allies. It's about relevance. And the real question is no longer whether BRICS will replace the G7, but how long the U.S. can pretend the handover hasn't already begun. Yet the most dangerous shift isn't economic. It's psychological. Washington no longer speaks like a superpower setting global rules. It negotiates like a creditor chasing leverage. Trade is becoming tribute. And the collapse isn't one of economies. It's a consent. Because once allies stop believing in the deal, it's not the tariff that hurts. It's the silence that follows.